Hello, Pradeep sir. How are you?
Hi guys.
Pradeep sir, good evening.
Good evening.
Good evening, everyone. Mansi, when you're ready, I'm good to start.
Hi everyone.
Mansi?
Sorry, I was on mute. I think if Suresh sir is okay, I think we already passed 8:03, so and we have a good number, so we're good to go, I think.
Sure. Confirm me if you are able to see my screen.
Yeah,
Yes. Over to you, Mansi.
thanks, Vamsi. Good evening, everyone. Welcome to our second session of Thursday Night Talks. Today, we are going to be covering the topic investing fundas from a serial investor. But before we dive in there, quick guidelines to our participants. As you see on the screen, you will remain mute for most of the time. If there is any question you would want the speaker to take up, please you make use of the chat box. Any questions are there? Mostly we would see it being taken up by our moderator during the Q&A time. In case you're finding any issues with the connectivity, we suggest close any video sharing apps, or you may simply just want to log out and log in again. So these are the guidelines. If there is any issues, please feel free to connect with one of us from TAI. So once again, welcome to TAI. Those who are not TAI members, just a quick brief of what you see about TAI. So thank you for joining everyone. This is what TAI Hyderabad chapter is about. Please feel free to connect with us. You will find more details on our website. And this is the objective we see. Why TNT, Thursday Night Talks? It's more of understanding our charter members, what and where they come from, what are their passions, and that's the purpose. So if you have any questions through the talks, please make use of the chat box and put up your questions. With that, it's definitely a pleasure once again to invite moderator Dr. Rakesh Bhatia. He's the founder and CEO of the Capital Net. Rakesh sir has been associated with TAI for a very long time. As you see his profile, I would just like to sum it up in a few words. He's been a super mentor. He's been with TAI for a very long time. He has been mentoring our students. He has been mentoring the women entrepreneurs. He has been mentoring a lot of startups. Thank you, Rakesh sir, for joining in. I welcome everyone here. Welcome to our board members. Welcome to our charter members. Welcome to our associate members who have joined it. Welcome to our speaker, Venkat Vallabhaneni sir. Thank you so much for joining in. And with that, I hand over the session to Rakesh sir. I request you to please introduce our speaker, Venkat sir. Over to you, Rakesh sir. Thank you.
Thank you so much, Mansi. It's a pleasure to be here on this session today. It always is, for that matter. As you rightly said, I've been with TAI forever and have had the privilege of learning from the TAI members during my early years. So I've been with TAI since 1999, for that matter. So I've learned a lot, and it's always a further pleasure to be able to contribute wherever I can. Having said that, I'll jump on. The session says it's more about knowing our charter members, and today we have the privilege of having Venkat Vallabhaneni with us. Venkat, welcome. Very interesting gentleman, a friend and a supporter, an advisor, a mentor for myself. So for a long time, I have had a privilege of knowing him for a while. Said very interesting profile that he carries. He's an entrepreneur turned corporate executive turned entrepreneur turned venture capitalist. Has worked with corporates like Bank of America. Currently heads is the managing partner of a fund called Inflexor Technology Fund, a deep tech focused VC. Prior to which he was also the managing partner and founder of Parampara Capital. Has been an investor in some major stories. And there's a lot that I believe we will be learning from him today, both from his journey of of going from that entrepreneur to corporate to entrepreneur to investor, and also we see what is it that you can extract out of him. So as it's always said, the best way of getting the best out of a session like this is to ask questions. So I would encourage all of you, while I will do my best to ask the right questions from Venkat, and he's pretty vocal in terms of his opinions as well for that matter. But I advise all of you to ask questions which really matter to you, right? So Venkat, welcome. Let's see. Venkat, you're on mute.
Okay. All right. So I was trying to unmute actually, Rakesh. Right? Yeah. Thanks, Rakesh. Right. Glad to be here. I'm seeing a lot of accomplished people in the audience. Right. Whatever I can help to sharing my story. Let's see where it goes. And any questions you have, feel free to ask. And
Oh, absolutely. No, I'm sure it will be fun for all. Fun in terms of learning, because learning is always fun, as I would say.
Sure.
Even the accomplished people, we all learn from each other. As I said, you have been a guiding force for me in many ways, and so are many others who are in the room today. And I believe we will pass that on to many of the newer entrepreneurs who have joined us in this conversation. So welcome again, and we probably will start. I would not take much of the excitement away from our audience who are waiting to hear from you. So let's start quickly jumping into your life journey. As I said, the interesting life from entrepreneurship to corporate to entrepreneurship to the VC to the next level of the VC, and then I don't know where on from here. So let's hear it from you.
Sure, absolutely. So I'll quickly start from the way from my college days, right? After doing my bachelor's in mechanical engineering in Manipal, right? Then I had a quick stint with my father's business actually, right? He was at that time doing construction projects with ONGC, right? And so I joined him and took up a couple of projects on my own. Obviously, I lost money in those two projects for sure, and it was not an easy one, right? Because lessons learned very hard way, right? And it was a significant loss as well. Then I thought it wasn't my cup of tea to do the business here, and let's figure out go to the US and figure out what to do, right? So that's when I took TOEFL and GRE stuff like that. I went to the US and joined master's program there with computer science. And there, after finishing the computer science degree, I had two choices, right? Whether to join Wall Street or to join Bell Labs, right? I was in New York area. So, obviously I took on a Wall Street route, which I'm glad I did, right? And, once I went there, I had an opportunity to work across many banks and investment banks there, right? So there I was working on trading desk, primarily on the sales and trading side of it, right? And where technology, of course, right? And at the time, people used to sit on trading desk and helping these traders, right? And this is a fixed income trading across different asset classes, right? From bonds to credit derivatives to structured products and stuff like that, right? So great experience and very tough job, right? Because it was not easy, right? Because and a lot of pressure out there, right? So, but it taught me a lot of things, right? During those periods. So I have done that for more than a decade, and started one company called Accurum in late 2000, right? And Accurum was primarily serving the same clients, which are Wall Street clients, but was doing it's in services sector. We were serving the again trading and sales side of it across different asset classes, setting up the trading desk to setting up the trading systems and stuff like that, and high-end consulting, right? It worked out very well, because I established contacts during my 10 years stint with the banks, right? So it has given enough business for me. One thing I learned there is, right, founders and are the ones, right, who bring a lot of business to the company, right? Initial startup time frame, right? It took 2 to 3 years was because of my contacts, and I could get the business. After that, I was able to hire people, sales and marketing guys, right? So then it started growing. So what happened was in 2004 timeframe, the business was growing. I had choice to either raise the money or exit, right? I got an offer, from many companies actually at the time, because everybody was trying to get into that sector. And also I got a couple of term sheets from sort of a PE sector, right? But at the time, my thought process was, let's go back to India, right? A couple of reasons for that. Again, I had two boys, one was in probably 10 years, and one was probably 5 years at the time, right? And wanted them to grow up in India until they go to college and get to know their culture and stuff like that, right? That was the main driver for me to come back to India. And second thing was excitement about India, right? There's been a lot of talk about what's happening there. So because of two reasons, I took the exit route, right? Sell the company, take the exit and move back to India, right? And then at the time, again, right, because in the multiple term sheets I had, I was looking for a couple of things. One is a cash exit, and second was minimum time to serve as part of the integration, right? So, and both of them were are fulfilled by, at the time, Canway, right? I got reasonably good exit, and then 1 year is the time frame to stay, and took it, and right after the time I came back to India, right, and sold the house and everything. Came back to India. At that time, after coming back to India, again, I never worked in India except my father's business, and it was kind of baptism by fire, right? After coming here, looking at 2-3 sectors at that time, and what happened was I met a person who was in the 2 sectors that were of interest to me, right? Healthcare and sort of energy sector at the time. And energy sector, there was a guy who was working in the batteries segment. And I thought that was something, energy storage was one of the areas that was interesting. So I sort of became, co-founder in that, right? And it was a company, founded in between Hyderabad and Vijayawada, and acquiring around 60 acres of land and getting the permits and stuff like that. And the capitalization at that time was around 100 crores plus, right? And what happened was that was part of the capital was raised from banks at that time. Venture capital, those things were, it was in 2007 actually, right? PE was there to a certain extent, but no early stage investors at the time as much. So went to the banks, raised debt funding, and it was great experience actually, right? Because for me, learning the ropes in India was probably the best, through that route, right? For me, manufacturing was new, and starting something is new, and then going to the bankers to raise money, getting the permits, it was like drinking through fire hose, and tough, right? 2 to 3 years. Manufacturing is not easy for sure, and many of you have the manufacturing sectors, I'm sure, right? And 2 to 3 years it was tough, right? Probably, and then we are losing money left and right, and a lot of money went in there, and eventually started paying off slowly, right? And the company got acquired by a company called NSS, which was an NYSE listed company at the time. And even that acquisition was a kind of an experience, right? Because they came back, they looked at the company, and they were looking for India entry, right? And it was, interesting. They came and visited, and and they took some time. Negotiations were hard, and the company was doing good revenues, but the point is profitability wasn't there, right? So it was doing 200 crores, around that range as a revenues, right? But profits were, in manufacturing sector, and gross margins was low, and stuff like that. So, but it was a good, decent exit for us, right? The company got acquired, and right after that, I was also looking at one more sector into healthcare side of it. Somebody came to me, right, with at that time 2010-11 timeframe, right, and connecting the doctors and patients using the telemedicine, and so I put some money there as an investor, and but B2C part of it never worked because the infrastructure was not there at the time, right? And video conference wasn't working. Second thing was mindset was not there at all, right? Doctors and patients. Now everybody wants to do it on telemedicine, but it was tough. So moved away from that into different model and working with the state governments and stuff like that. That model sort of worked out well. Eventually, that company also got acquired, right? So that was a good exit for as well, right? And then in the meantime, what happened was I had some friends in the US working for Bank of America, right, in senior positions, and they were trying to set up a technology division for a long time, right? They had mixed success, and they didn't have anything, on to show at the time, right? So, and I joined them as a first employee, right? In the US, actually, in New York City, right? I traveled like 2-3 times every week, and joined there, and then came back here as I was on the US payroll, right? And it took, I joined them with the 2 to 3 years of commitment, saying that I'll establish the team and I'll move out. So that kind of became 5 years after that, right? So by the time I exited, the team was around 7,000, 6,000, between 6,500 to 7,000 people, right? And initially, I started with the global markets technology side of it, and then took over the whole technology, and then also had some operations folks eventually. That was also great experience for me, right? Because it was Bank of America is like 300,000 people, and conglomerate spanning across different countries, and working with the corporation with with its own life, and they have they encourage entrepreneurship internally, but it's very tough, right, to get things done in the large corporation. It taught me how to get things done, and in those bureaucratic environment, actually, right? But nevertheless, the company is very, very good, right? And during that time, there were 2 acquisitions that happened globally for Bank of America, right? Countrywide Financials and Merrill Lynch. It was also very good experience to have the companies integrate. They have a decent India presence as well, right? And we had to go through US and stuff like that. A lot of integration issues and stuff like that. So no, again, that was on the Bank of America experience. From entrepreneurship to corporate. And once the team has been established, it has become very, very monotonous, right? It's the same job every day, and go there and make sure that things happen, meetings. So it wasn't for me. So I said, let's give it to the next level. And I quit Bank of America. And at the time, again, was at the crossroads, was looking at what to do, and started investing in companies as angel. 1 crore here, 2 crores there, stuff like that. No, wasn't a great experience actually as an angel, right? But it taught me 2 things there, because as angel investor, when you put the money, I face a couple of issues, right? One is any seed investments are fine, you as angel can get in, but any growth companies, right? So any growing companies, they were not interested in angels, right? They were looking at institutional support, either venture capital or larger VCs, right? And that was we're not able to put our put a foot into the larger growth companies. That's one issue. Second has been the governance, right? When you tell the people that as an angel investor, I want you to do this, they won't take you seriously, right? Because again, you are operating as an angel. So those are 2 experiences I had. Then I said, why not look at as a let's look at starting a fund, and obviously with our own, putting our own money is part of it, and also get some institutions as part of it as well, and some family offices. So very limited set of people, and we went on with a 100 crores capital fund, right? We did that, and again, it is a great experience, right, to raise the funds, put your own money and stuff like that. And then after that, right, it is like a startup, right? To be honest, fund is nothing but a startup, because there are 2-3 reasons for getting into this business for me. One is entrepreneurship, as most of all of actually, right? It is addiction, right? In my view, and you want to do it, and fund is also a startup. And second thing is, this is probably entrepreneurship is the probably most noble and profession in my view, right, in the world, right? So I want to be close to entrepreneurs, learn from them, because learning is a major reason I got into funding, into venture capital, right? Because you tend to meet so many people day in and day out, right? You learn from them, whether they're young or experiences, and then that's one of the reasons I got into that. And the third one is, right, you share your experience and help them to grow. I mean, that would be one of the best things that could happen to you, right? And so 3-4 reasons, I got into that, and I totally enjoyed today, right? It's the best profession I think we could get into. And we did 12 investments as part of it, right? And out of those 12, we had one complete exit, one partial exit. We returned around 55% of the money or 60% money back to the investors, and so far we're running at 65% IRR. Again, these numbers are numbers, right? But as we move forward, we'll get to the final numbers as the fund returns the money. So far, there are no closures or non-performers. At this point, out of 12, 10 companies, one exit and one partial exit. 10 companies have received follow-on funding, either Series A or Series B, and 2 companies are yet to get there, right? So that's been the record. And we with that, one apprehension I had at that time was whether in India would be able to find good companies in technology field, right? Even fund one was focused on technology, and that was, we were proven wrong, right? Because but there's so much noise. But at the same time, if you're able to cut through the noise, we were able to find good companies. I think one thing is the companies need to reach out to the investors no matter what, right? Because none of the investors ignore the mails they get, in my view, right? So, but nevertheless, we were able to find good companies, gave us great confidence to start the new fund. So that's when we embarked on new fund, because size of the fund in the first one became sort of a limitation as well on us. Because what happened was, with 100 crores, we had the limitation of 10% of the fund is the maximum we could do, right? In a given company, right? That was around 10 crores. And that became a limitation, because if you look at now, more than 500 crores of follow-on investment happened in our companies. And we could not take larger positions because of the risk limit. So with that, new fund, we put on 500 crores as a new fund. And there in this new fund, we would take exposure up to $3 to $4 million, up to 30 crores, I would say, right? In any given company over the period of time, right? So that's a check size we are talking about. And also in there, right, we are talking about 70% of the fund would go to early stage companies, and 30% will go to Series A, Series B, right, which is late stage. Obviously, late stage companies will have higher valuation, but I think it will give us better, balance in the risk, I think, right, in the portfolio, right? That's a strategy. You want to ask? I mean, I can continue talking. If you,
Yeah, no, I think I probably would jump in. So I would say it's a brilliantly narrated journey so far, and some of the interesting facts. I think one of the very few individuals who I've heard saying that going to the bank and raising debt was an interesting experience. So I don't know what made it experience for you. I don't know if that interesting meant good or interesting meant challenging, whatever it was. But yeah, I never heard anybody saying that. But I see a couple of things that we can probably pick out of this whole journey from you, right? And also considering the mix that we have in our audience, right, between the charter members, seasoned entrepreneurs, and the aspiring or maybe early entrepreneurs. I would like to break the conversation in a few things, picking from your journey itself, right? One, how easy. I'll probably narrate the quick questions quickly, right? Few of them, and we'll take them here and there in no particular order, right? How easy or difficult it is for somebody to move from corporate to the entrepreneurship life, right? As you said that it's an addiction, but then those who have not experienced and want to get into it, they have their own dilemmas. You said that you have been lucky with your fund, no write-offs so far. Again, from a fund side as well as your side, as well as the startup side, what is it that takes to be worthy of becoming a non-write-offable startup, or worthy of you picking them up as an investment? Let's start with these two questions, and then probably we'll mix and match. There are a lot of other things. I'm curious about all the 3 or 4 exits you have made, how to make a company worthy of those exits. Again, no write-offs. So we'll pick up a couple of things as the time allows us, but then let's start with the movement of an individual from corporate life to entrepreneurship, and then we'll come to the other side, seeing how a startup makes itself worthy of being investable from a fund like yours.
Sure. I think, my journey was entrepreneurship, initially job, entrepreneurship, for longer period, and then corporate job again, and then back to funding, right? So that's how it went, it has gone. I think for people that have spent enough time on the corporate side of it, to move to entrepreneurship is probably a sort of a difficult decision for them, in my view, right? But if you're passionate about entrepreneurship, I think you should take that bold decisions and jump into that, right? Because
What are those top 3 things they should be ready with,
yeah,
prepared with?
sorry.
The top 3 things you suggest they should be prepared with if they are taking that plunge.
Yeah, because first thing is uncertainty, right? That's something you would not know, right? What's going to, so long as you're able to take the first step, that's fine, right? You have, next, 2-3 steps are visible, that's fine. Don't worry about what's beyond that, right? So long as you have that mindset of paving the way as you go on. That's the kind of mindset you got to have. Second thing is winning, right? Basically, once you embark on journey, right? Let's say you want to do something, you do enough homework, and and then make sure that convince yourself that that's what you want to do, and then in your mind it's done already, right? It's completed. So with that mindset, you get into the job again, right? So I think winning mindset means it's already done. I'm going to get it done anyway. So uncertainty, ability to handle that. Third one is pure hard work and focus, right? I'm telling you, I'm sure there's, as I said, there's a lot of accomplished people out there, but from my side, whatever I did, hard work and complete focus in what you do will always pay off. I think those are 3 things I would say you need to be a successful entrepreneur, based on my experience. And from the corporate job to becoming an entrepreneur, it is a tough one, right? Especially if you have spent long time in corporate job, right? Because you're used to some cash flows and stuff like that. You got to make plan and jump on it, and make sure that you do enough hard work or homework, right, before you get in. And there is the success rate is probably 50-50 in my view. Once you corporate job to to entrepreneurship, because 50% of them go back to corporate job, right? It's like US to India, right? People coming back, and 50% of them go back now, right? So that's how I feel, right? So that's the first question. What was the second question?
Many of them probably go back because they got a nice exit like you did and joined the corporate back as well.
One is that, and second thing is, I think we tend to give up early, right? Because generally it takes, I would say, 4 to 5 years for any company to be successful. Because
I was just trying to take the fear out of the listeners'
right.
head, right? It's not always because you fail, you will go back. It probably could be the exit as well that will take you back.
No, I think as I said, right, people tend to go back because they give up too early, right? I mean, I think you need to plan for 4 to 5 years minimum. I think for any company to be somewhat reach a reasonable state, right? First year would be fine. Second and third years are the most difficult ones, in my view, right? And people tend to give up in those 2 years, and because you'll be run out of the money, and then second thing is you won't be having enough. People following you, team issues would come up. And then obviously sales and marketing, they won't focus on that as much, right? You won't see the clients coming in, because those are the main reasons people quit and go back, right? So
that's an interesting point you brought in around the sales and marketing and the reasons why sometimes the startup fail. And I think that's where the connected question was, right? So once somebody has taken your advice and has become an entrepreneur, have lived that journey for a good 2, 3, 4 years, what is it that you see they should have achieved, or at least should have the properties that they have inherited from the time they started to become a startup worthy of investment, like from fund like yours?
So, I would say I would take a few things, right? What we would look for sure in a startup. First thing is founders, right? Whether we used to give the founders as a second priority in the previous fund, right? Now we moved it up, right? First one we look for is founders, because without them, you're pretty much done, right? So the founder's mindset, and then if you have a partner, how are you working with your partner, right? And what happens is once you go to some investor, it would take probably 4 to 5 months at least minimum, in my view, right? From the moment there is some interest, first call to actual investments going in would be that kind of time, minimum 4 months you got to give, right? So during that time, we'll have multiple meetings. We'll watch these founders very, very carefully, their body language, how they deal with each other, how they deal with us, right? That's a most important thing we look for in the their ability to go through the bad situations and ability to handle cash flows, understanding what they're talking about, business plan, and stuff like that, right? All those things we watch very, very carefully. Second thing is product should be somewhat proven, in the sense that should be beyond the prototype, right? And we look at products to be at least 2 to 3 years of barrier of entry. That means there's everything anybody can copy, right? But if somebody wants to copy, you should be ahead of the game at least by 2 years, right? That's something we would look for sure. And the third one is obviously the market size and other things as well. This is also very, very important actually, right? Because what I see, especially from my experience, many entrepreneurs tend to overestimate the potential of their business, right? The product they have, right? Because they don't do enough homework in terms of looking at companies around them. And that's one of the main reasons companies get killed, actually, right? Because they're not doing enough homework and finding out what kind of competition, what is your barrier of entry compared to them. That's the most important thing, I think, right? From the company's perspective, right? And that is something you need to focus on. Do a lot of homework, top down, bottom up. That means, when most of the time you hear companies talking about it is $1 billion market, $10 billion market, we're going to take only 10% of it or 1% of it, right? That's the kind of talk we see. But there's not enough bottom up research, right? How would that 10 billion commit? How would you attack the market, right? That's kind of a bottom up planning as well. So you need to have both, right?
Sure.
That's the next one. And the third one is, obviously, go to market and other things we look at as part of it, right? Because and financial planning along with the go to market, because many companies, many founders, they don't understand financial planning as much, right? In terms of cash flows and P&L and how does it work and stuff like that. Many of them are not aware of it, and they don't necessarily give a lot of importance to that as well, right? Because that's another thing you need to focus on. If you don't have the expertise, take help from experts. There are advisors and bankers out there you can take help from, right? And the last thing is exit, right? For example, as you know, I'm an entrepreneur as well as a fund. So what is our business? Our business is, we put our own money, and also we take money from others, and we want to help the companies and eventually also give the financial returns to the investors, right? So general, if you look at the life cycle of companies, you can think about seed stage, Series A, Series B, Series C, probably exit, right? I mean, stuff like that. A typical company. Each stage you can give, right? At least 2 years minimum, in my view, right? So you should plan according to that. But if we get in at seed stage, we look for exiting at Series B kind of thing, right? So a typical company, right? 4 to 5 years is a time frame any venture capitalists or investors would commit max, right? And generally, because fund lifetime is around 7 to 8 years, right, max. So, and then we invest for the 4 to 5 years, right? So that's where we look for 4 to 5 years of exit. Mm-hmm. And then we should look for that. Generally exits happen in this environment based on India, right? Because if you look at Indian ecosystem is still evolving, long way to go, right? Because if you look at the numbers, in last year, India, we see numbers are around 10 billion compared to 170 billion in the US, right? So that's a kind of difference out there, right? So the VC system is evolving. Most of the money, even in the VC system in India, is like foreign money, actually, right? There are a lot of foreign funds out there, and also foreign companies are getting, acquiring the companies here as well. So 50% of the exits will come from, in our view, from the strategic acquisitions, and 50% would be from funds investing in the follow-ons, right? That's how we look at. So when we talk to the entrepreneur,
Ever seen an IPO coming in?
IPO, I think there would be, I would say 5 to 10% of, if you talk about our current portfolio, I would say 1 or 2 companies have the potential, right? At least one for sure, right? And so, but I wouldn't. IPO is a tough one in India, right? Right now,
Most desirable and still most rare.
Because beyond Series C, obviously PEs come in and IPOs come in, right? But that's probably beyond our scope as a early stage venture capitalist, right?
So I pick up from your cues from your narration, right? So founders to the product and the advantage of that lead time, 2 to 3 years on the product, go to market and the exit strategy. But just quickly going back to the founders, you as you said that you observe them over that 4 to 5 months period. Does it ever happen that you decide not to invest towards the later part of that 4 or 5 months?
I think, in the first month or 2, right, you would know, right, pretty much, right, what's going on, right? Because we don't want to also, extend because you're wasting time for them as well, right? Because they would rather go and raise money from others. So we do that term sheet, within the due diligence, general time frame is, right, once somebody approaches us, it'll take a month or so to evaluate the business opportunity, right? We call it a business diligence.
Sure.
Within a month, we do something called investment committee meetings, which is basically we need to get approval from the investment committee for the opportunity, and then we give the term sheet. Term sheet negotiation will take probably some time, because it's not, many folks underestimate the time it takes to negotiate the term sheets as well. And then once that is done, due diligence starts, right? Actual financial and other things, right? So term sheet negotiations will take around a couple of weeks. DD takes around a month and a half. And then actual documentation takes another month or so. So during this term sheet negotiations and DD itself, right, it'll, if something needs to fizzle out, it'll go away, right? So that's it.
So we have started receiving the questions. I'll try to pick the few of them intermittently.
Sure.
Right? And connecting the first one, which is in the sequence that we just spoke, right? So you gave the advice of around how somebody from a corporate world can become an entrepreneur, how somebody can become investable, right? And there's a first question which is from AV Rao here, which says, how do you monitor the portfolio? So a startup invested, now portfolio, right? How do you monitor your portfolio, and how do you keep them motivated and on track, right? So they don't give up.
Right. I think it's a very good question, actually, right? Because, as much importance we give it to the investment, similar kind of importance goes to the post-investment process as well, right? So, and generally what happens is, if anything, during the documentation phase, we put in conditions. There's something called conditions precedent and conditions subsequent. We find any holes, they need to fill that in within certain time period and stuff like that. And beyond that, we also put a business plan, and then we also put in schedule to review, right? Every month there'll be scheduled reviews, right? We call it monthly review meetings. And during those monthly review meetings, we have the pro forma, the business plan worked out for the next 1 year, at least next 12 months. That's a projected financial plan or targets as well. We review every month, actual versus what was planned. If there's, and help these companies in terms of where the help is required, technology, sales, finance, whatever, right? So obviously none of them will meet the targets, right? I mean, many of them miss. And then we need to adjust the targets on a rolling basis, and also give them help as they move forward. These monthly review meetings are very, very critical, right? And that's one thing. And during these monthly review meetings, entrepreneurs should feel the VC is adding value, right? It's not about only questioning them about you haven't met these targets and stuff like that, right? It is about really treating the companies as our founders as partners, and then that's where that's very critical in our view, right? And at the same time, bring the accountability.
So when you say monitoring and also helping them, because monitoring I can understand, right? It's easier to ask and review, right? And probably help them stay focused by reminding them of the targets that were discussed. But in terms of the contribution with go-to-market, in terms of contribution with looking at the next round of investors, in terms of contribution with hiring the new teams, executives, etc., do you have a contribution there as well?
Absolutely. Every month, right? They're in constant touch with us, right? We know what happens is during the first phase itself, right? We know where the gaps are, and then we put a plan together, either through venture partners or bringing the right person there. And as the time goes by, I mean, right from interviewing the sales guys, interviewing the key hires, and also putting contacts in place for them to close sales and stuff like that, and finance side of it, you all the areas we touch, right? Based on what they need, where they need help, right? And critical thing is also, as you rightly said, follow on funding. Generally what happens is our network with other funds is also becomes very important and critical there, right? Because as generally 18 months is a time frame we see where fund generally the runway companies will have. So assuming that it takes 6 months to raise the funds, so you need to start 6 months before before the runway ends, right? So we help them to raise the funds, because many of the funds would continue to expose these companies to our contacts, right? So that helps them as well as they move forward.
Sure. So I'll probably go back to one of the things which I said I would like to pick up from you and your journey, and that kind of connects in this whole sequence that we're talking about. We'll come back to the questions again, but that so again, as a reminder, right? Becoming an entrepreneur to becoming an investable startup, becoming a strong portfolio of yours to an exit. Now that is what I wanted to go back to your journey and ask. 3 good exits. What makes a company worthy of a good exit, and how does a company actually work towards it? So that's point number 2. And third is, how do you actually realize? So I've personally seen startups and entrepreneurs become too emotional about their business, and the exit through a strategic sale is generally not a good emotional decision for them, right? So picking these few points up, what do you say are the right strategies or approaches to get a good exit from your startup?
In terms of what your question about exit, right? Why what would make the company sellable or exitable, if you want to call it that way, right? So
and also both from the strategy and the business perspective, as well as from the entrepreneur's mindset perspective.
Right. So entrepreneur's mindset side of it, right? You should be very clear right from the beginning, right? What you want to do. And in my view, right? In India, when I came back from the US, and I'll go back to what my experience has been. In the US, when I sold the company, it's a pure business, right? And no emotional attachment, be done with it. When you come to India, and when you're selling a company, people feel that you're not doing well. That's why you're selling the company, right? I mean, that's been the little bit of a mindset when in 2000, 10 years ago, right? Now it has changed. But the point is, as an entrepreneur, you got to be very clear, right? What you want to do in 5 years, 7 years, right? And typical answers we get when we talk to founders, right? What's your exit plan? So they say, sir, we're going to stick around, right? We're going to grow this company to whatever, right? So again, that's a good answer, no questions. But the point is, you should also talk about what is your goal financially, professionally, all those things you need to think through. And you want to think about from our perspective as well. You got to have the exit plan very, very clearly, and also during the exit plan, right? There are 2 ways, right? in 5 years, let's say, or 7 years, you want to exit the company. There, a strategic acquisition is probably one way to go. You can still continue with the company that is acquiring you as part of, to grow that business, right? That is one possibility, right? And second thing is, you exit and you start something new, right? So you should have that plans longer term, what you're going to do, right? I think that clarity is required, first thing. Second thing is, once you have clarity, how do you want to make it, attractive to potential buyers, right? And there are only 2-3 ways, right? I mean, basically IP, if you're focusing on, your product, right? I mean, though your sales are not there, if you have a great product and, if somebody wants to acquire that is a possibility. But most of the time, if you have, good sales, not necessarily you're profitable. For example, growth companies, right? The acquirer would look at few things, right? Whether the revenue is increasing, right? And by adjusting the business model, would if they're putting X amount of money, would they make more than that in the future, right? In the next 3-4 years, right? Generally, acquisition is about making money as well, right? So that, business model, that's one way, right? Your business is making money, and by adjusting, it will make money in the future. There's positive cash flows and growth there. That's one option. Second is, you have a great product, right? Which companies will look at and say, acquire it and merge it with their product suite, right? That's a second way, right? And outside that, right? Outside that, you have the exits of, as you rightly said, PE, taking the PE and going the IPO route, right? If you grow to a certain point, you become profitable, and then you talk to the larger funds, both late stage funds as well as PE funds, they would give you exit meaning they'll buy out some secondary, from you, give you some comfort. You still have, stock on the table, but you have some comfort, right? Some partial exit, and then you continue to grow the company. That's the third way you can look at it, right?
So yeah, I think that's a great insight in terms of one, not getting emotionally attached to your business and business ideas. Be practical about
absolutely
where you want to go, and whether to what extent you can scale your business, and what is the right threshold when you should be looking at the exit. Maybe is a good mode you set. I believe a lot of entrepreneurs who are listening to it would find it very insightful here. I'll jump back to the questions from here, pick some of them from the audience, again in no particular order of receiving them. But I saw one interesting one, and I don't remember whole of your portfolio. I know you have a fairly big portfolio. I'm not sure. Do you have any social impact investment that you have done? That's one of the question here. It says, what's your experience with the social enterprise investments?
We don't have any impact investments, right? But we have something closer to that, in my view, which is Chakra Innovation, which is a sustenance side of it, right? What they do is they have this device that attaches to the large gensets and reduces the particles out there, right, or pollution, and generates ink, right? That's a sustenance kind of it. They're doing well. And beyond that, we don't have any impact investments, right? So we are mostly on the deep tech side of it.
Sure. So there's another interesting question here, Venkat, which kind of connects with what you are saying. So I derive that you work very closely with the entrepreneurs and majorly into an investor operator model, right? Helping them grow, sustain. But from the early stage, the current ecosystem, and somebody as rightly pointed, a good accelerator versus a fund like yours, right? How do they compare?
I'm sorry, good accelerator versus fund like ours. Yeah, is that what it is? Yeah.
A close operator fund who mentors so closely versus working with an accelerator. How does it?
I think
what do you say is the difference?
Yeah, I got your point, right? Because if you look at companies' life cycle, seed stage versus early, I would say pre-series A, right? We come in pre-series A growth stage. In the seed stage, where the accelerators and incubators come into picture, right? And we take it from there, right? Where the growth is required. I think in the current environment in India, and again, it's my view, right? Till you go to Series A and sometimes Series A and beyond, actually, right? Entrepreneurs need some good help from the investor, right? The so-called operator investor, right? So, once they go to that Series A and beyond, that's when you can take the foot off the pedal, right? So, I think during that period, initial seed stage would be the incubators. From the pre-Series A stage is where we come in, where we help the companies to grow, and then sometimes we also help during the first period of Series A, after Series A, raising the Series A.
So it's basically a good coordinated relay where baton is passed from a good accelerator to a fund like yours and then forward.
Absolutely.
Awesome. So again, I'm picking another question again, in no particular order. I know if I'm missing something, I'll probably try and come back to those and top in the line. But then pivoting, yeah, this is an interesting one, right? So many times there are situations, and again, I think entrepreneurs do not really realize that they require a pivot even while they are sitting at that crossroad. Have you seen those situations happening in your portfolio companies or otherwise? How have you helped them either stick to the path they have taken or help them pivot? Or do you encourage pivoting? You do not encourage pivoting? What is the general view about pivoting?
No, I think pivoting is definitely required when when the business model is not working well, right? Especially, but you have the assets that you can leverage. So I think I have a personal experience actually, right? As I said, the healthcare company initially that was into B2C model, connecting the doctors and patients, and they have the technology, right? The whole workflow and video conference and stuff like that, and integration with the devices, but B2C did not work. So we looked at in the Indian healthcare system. Obviously, if you want to scale, you end up working with the government in some form and shape, right? So that's where we started looking at this. Some of the areas where we can work with the government and help the change the business model, right? That's what happened. I was an investor there, by the way, not a founder. So that was prime example that got sold eventually, right? And also in our portfolio, I would say Attenberg, one of the companies. I'm sure Attenberg fans, right? There's a most energy efficient fans in India right now. And they started with the B2B model, and they hit the scale issue, right? And after that, their goal is to create a brand. They went into B2B2C and eventually B2C now, right? So when we invested, that was not the intent. So they moved to different model altogether right now, right? So because of the growth they are seeing. Again, same thing happened to a couple of other companies, right? But it is important to have the open mind and ability to pivot as required, and not only business model, but also if you're able to leverage the assets in a different way, so be it.
Sure. So we're coming to the close of the time. What I will do is I'll take last three questions. Again, if I miss somebody, please excuse me for missing it. It's not intentional. I've just picked up random three here right now. But then quick answers to those. First one, which is very closely connected to what you were saying in terms of supporting your startups with a lot of handholding, right? The interesting question from Pradeep here is, can it be process driven? Can the mentoring be process driven? Or is it art or a science?
No, I think it's more of it is more of a science in my view, right? And a bit of an art, but majority of it is science, right? It should be process driven, and the art side of it is to be able to work with the founders, right? Understanding them and then working with them closely, in the emotional side of it. But majority of it is processing.
Understood. Very cool. Again, I'm kind of rushing because of the time. Yeah. I know we could have a lot of this question. This is a fairly long debate that we can have on this topic itself.
Sure.
But then getting on to this again, I'm going random and I see a question that says, how do you see startups investing on the innovation, right? And how do they really protect their innovation?
when you said protect, I mean, there are certain things you can do, right? But in my view, patents and stuff like that, right? But in my view, I think so long, this is the world, people can copy anything. I mean, don't assume that you can protect the IP forever, right? So you need to keep innovating. That is for sure. You have to keep yourself ahead of the game. As I said, 2 to 3 years is what we look for in any given point of time, right? So be prepared for more innovation, more investment in innovation. Be prepared that somebody is going to copy your IP as well. Very, very hard to stop them, actually, especially.
But then are the startups really beyond certain point? Are they really investing on the innovation? Because I know you invest in them because they are innovative. That's the essence of most of the startups today. But do they continue to invest on the innovation, or how's it? What is your general experience around that?
No, especially technology changes a lot, right? I think, for example, I'll take again Attenberg's case, right? Attenberg, right? They were working on fans. Now they want to move into, mixers and grinders and other equipment, ACs. So they are applying the same mechanism, the energy efficient, into different appliances, right? They continue to look at different things. Same thing, all the companies, space tech company, their propulsion, now they're looking at space tugs and stuff like that, right? So the continuous innovation is key, and continuously move forward ahead of the game. That's my view.
Sure. So I'll pick two. One last question, since I said three, I will make it three by combining two questions that I see. They're kind of related.
Sure.
One, it says that 94, some stats says that 94% of the startups do not survive because of the lack of money. I'm not sure if it is they are worthy of the investment, not worthy of the investment. There's a different debate, right? What is your take on that? And a connected question to that by another gentleman here, Anubhav Tiwari, is why do companies get stuck at one stage for a long time, right? For example, seed to angel to VC and so on, right? Why do you not see the quicker and longer jumps between those? So kind of trying to connect two questions, and probably that is where we will end our question answers. So anybody who's left out, please excuse me for not taking that up, but then
Hello.
and perhaps we'll call it.
Sure. So quickly, you guys are able to hear me, right? Because there's some discussion, what you said, Rakesh, right? But I think 70% running out of the money is probably not based on what I heard from the statistics, is around 30% of the companies fail because of.
It says 94%, in fact, I don't know where the stats is coming from.
These statistics are like, depends on who you talk to, right? Because generally what happens is, again, the reason, majority of the reason, the majority of the companies fail because of, I think, weak founding team, in my view, right? Even, the question you asked, right? Why the companies fail, get stuck in some situation, right? And why they fail. I think around 30% of them fail because of the weak founding team, in my view. Sure. And then these founding team, these guys, some of the founders, right? They're not willing to take help. They don't understand what they are lacking, right? Open mind is important too, right? That's one of the reasons we see companies getting stuck. Because my point is, there is enough money out there in a system, right? And then funds like us are not able to find good companies. That's a fact, right?
Yeah.
And if you keep an open mind, right business model and right team, you pretty much will be able to find, grow for sure. And, I've seen that happen many times. So I just keep that in mind for sure. Right.
No, I'll just add to that. I've seen it, personally and otherwise in my known entrepreneur circle as well, that if you are right, you generally don't have to go after the money. It comes in. It does. Because people compete, right? In some cases, right? Recently, I'll tell you, in the current fund, right? We are putting in a very, very early stage company. After we committed the term sheet, there's like, people are keep sending term sheets to them, right? Or there's a lot of demand coming in for the same company. No, I hear that. I know VC is a very competitive business by itself now. It is. Right. Yeah. So just that second part B of that question, and we'll call it, is the companies taking too long from moving from stage to stage. Again, I believe my assumption is you would say that it's the same thing: business model versus GTM versus the coordination between I think it's the founders here. I mean, if you ask me why many companies get stuck there, I think, there's always solution for every problem, right? That's a, definite answer.
right? Any problem has a solution. It's your ability to find that solution, right? People are not willing to have the open mind, search for the answers, take help. I think that's very important, because change your mindset, you'll be fine. That's my view. Again, all the answers I gave is based on my limited experience. Please, if there's any disconnect in terms of misinformation, please forgive me for that. But hope you enjoyed it.
Yeah, no, I think those are great insights, Venkat. I believe there's a lot that can be derived out of your journey. I wish we had long time, because we can pick a lot of points out of this discussion itself and make them a longer debate. I hope we are able to do that in future in some of the other sessions, if not TNT for that matter. But then thank you so much for taking time this evening. It's really valuable. I hope it was as engaging for the audience as it was for me. And from here, I think with the last quick apology to those who have not taken questions off, I'm sure we will find other opportunities to get you the right answers to the questions that have been missed. And with this, I will pass it on to Suresh, who's here now, and will close the session with his thoughts.
Thank you, Rakesh. Wonderful session. Thank you, Venkat. Great insights. Hope to get more of these sessions organized every Thursday. Thank you, everyone. Good night. Yeah.
Thank you. Appreciate it.
Thank you, everyone.
Sir, I'm closing the call. Yeah.